Have you ever noticed that the people who tell you fixed index annuities are amazing are usually the ones selling them? And the people who tell you they're terrible are usually the ones selling something else instead? I'm going to do something a little different today. I'm going to give you the real pros and the real cons of fixed index annuities. No spin. By the end of this video, you'll be able to judge for yourself whether one belongs in your retirement plan or whether it doesn't. Let's get into it. A fixed index annuity, or FIA, is a contract between you and an insurance company. It's not a stock market investment, even though you'll hear the word index attached to it. Here's how it works. Your money's growth is linked to the performance of a market index, something like the S&P 500, but you are not actually invested in that index. You don't own any shares. Instead, the insurance company credits your account based on how that index performs, using a formula that's spelled out in your contract. The single biggest feature of an FIA is this: your principal is protected from market downturns. If the index goes down in a given year, you don't lose money because of that. Your account simply earns zero for that period, and you keep what you already had. Now, in exchange for that protection, your upside is usually limited in some way. That might be a cap, a participation rate, or a spread. We'll come back to that when we talk about the cons, because it's really the central trade-off of the entire product. Everything about a fixed index annuity comes back to this one idea. You're trading some upside potential for downside protection. Let's start with what people generally like about fixed index annuities. Number one, principal protection. This is the headline feature. If you're someone who lived through 2008 or 2020 or any other rough market stretch, and the thought of losing a chunk of your retirement savings overnight keeps you up at night, this is the feature that speaks directly to that fear. Your contract value doesn't decline due to market losses. Number two, tax-deferred growth. Any growth inside the annuity isn't taxed until you take it out. That means your money can compound without the drag of annual taxes, similar to how a traditional IRA or 401k works. Number three, optional guaranteed lifetime income riders. Many fixed index annuities allow you to add a rider that guarantees you an income stream you cannot outlive, regardless of how long you live or how the account performs. Some people think of this as creating their own personal pension, something fewer and fewer people have access to through their employer nowadays. Number four, help with sequence of returns risk. This is a big one for people retiring soon. If the market drops significantly in the first few years of your retirement, right when you start withdrawing money, that can do lasting damage to how long your savings last. Having a portion of your money protected from those early losses can help smooth that risk out. Number five, death benefit and legacy options. Many contracts allow remaining funds to pass to your beneficiaries, often avoiding the delays of probate, depending on how the contract is set up. And number six, predictability. For a lot of people approaching or already in retirement, there comes a point when you're simply done taking big risks with every dollar you have. An FIA can offer a way to keep a portion of your money predictable and protected, while still participating in some market-linked growth. Now, let's talk about what you need to know before you ever sign a contract, because there are real trade-offs here. Number one, limited growth. Remember that cap, participation rate, or spread I mentioned earlier? That means you will not capture the full upside of the market in a strong year. If the index has an exceptional year, your credited return will be less than that, sometimes significantly less. Number two, surrender periods and surrender charges. Fixed index annuities are designed to be held for the long term, often 7 to 10 years or more. If you need to withdraw more than what your contract allows in the early years, you could face a surrender charge. This is one of the most important things to understand before you commit money to any contract. Number 3, complexity. Not all fixed index annuities are created equal. Index crediting methods, cap rates, participation rates, rider fees, they can vary a great deal from one contract to the next and from one carrier to the next. This makes it genuinely difficult to compare contracts side by side without help from someone who understands the fine print. Number 4, these are not FDIC insured. An FIA is backed by the claims paying ability of the issuing insurance company, not by the federal government. This is why carrier strength and financial ratings matter when you're choosing where to place your money. Number 5, liquidity. This is not the right home for money you may need to access in full on short notice. If having complete flexibility with all your funds is a priority, a portion of your money going into a fixed index annuity needs to be money you're comfortable locking in for the contract term. And number 6, income rider fees. If you add a guaranteed lifetime income rider, that typically comes with its own annual fee, which can reduce your account's accumulation value over time. That guarantee has a cost, and you should know exactly what that cost is before you decide it's worth it. So, given all of that, who is a fixed index annuity actually a good fit for? Generally speaking, it tends to make the most sense for money you won't need for at least 7 to 10 years. It's a good fit for people who want a portion of their portfolio protected from market downturns, not necessarily their entire nest egg. And it can be a strong option for people who want to build a guaranteed income floor to sit alongside Social Security so that your essential expenses in retirement are covered no matter what the market does. On the other hand, it's probably not the right fit if you need full liquidity on all of your funds, or if your primary goal is maximum growth potential and you're comfortable with full market risk to get there. So here's the bottom line. A fixed index annuity isn't good and it isn't bad. It's a tool. And like any tool, it works well when it's used for the right job, and it works poorly when it isn't. If you'd like to know more, get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. If you found this video helpful, please give it a thumbs up. It helps more people find this channel and get access to this kind of straightforward retirement education. And if you're not subscribed yet, hit that subscribe button and bell notification so you never miss a video. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.